not winning 90% of your new business because you have some sort of incredible value.
I'm going to take a bit of a different angle.
You know, I've got a budget this big. I'm going to give it to you because you have a really killer plan.
You give a Red Bull to a turtle, what do you expect?
I think that's a dead turtle. So let's move on to...
E-break.
Cheers.
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 Does your current premium finance company lock you into long-term agreements? That's because they don't want you talking to us. At IFS, we win your business the good old-fashioned way, with customer service. I know you don't always have to use a premium finance company, but when you do, you should use IFS. Cheers.
Hi there, and welcome to another episode of the Digital Insurance Pint Podcast. I'm your host, Tom Reed, and as always, I'm joined by my colleagues, Steve Earle, CEO of Cheap Insurance, Adam Mitchell, CEO of Mitchell & Whale, Jeff Roy, CEO of Excalibur Insurance, and today we are pleased to be joined by Jeff Radke, CEO of Accelerant, a new entrant to the Canadian insurance market. First, I have to point out that Adam is not currently in his basement as usual. Adam's in San Diego, so everybody join me in saying, boo, Adam, screw you for being in San Diego.
It's a virtual background, guys.
Sure, that's a virtual drink too. Jeff, I'm gonna have to go with Jeff Radke because we have two Jeff R's on this show today. But Jeff Radke, do you want to just give us a quick background about yourself?
Sure, thanks. It's great to be here. Started out as a reinsurance broker in New York with Guy Carpenter, transitioned to the reinsurance industry, mainly in Bermuda for 15, 20 years, and then moved to a company called Argo Group, sort of a middle-sized insurance enterprise that had operations sort of globally. Did a number of different roles for them. And then the latest gig is I'm the CEO of Accelerant Insurance Group, which was started in 2018 with five or six incredibly valuable colleagues.
And I understand you grew up not too far from the Canadian border.
Everything's relative. So I'm talking to you from Texas. I grew up in Wisconsin, which is a heck of a lot closer. Yeah, that's absolutely right. So if you want to know which direction to go from Windsor to get to Canada, I know that. I know Hortons. The basic stuff. I know the basics.
So wait. Let's go over those basics. Which direction do you go from Windsor to get to Canada?
South. The question, Adam, is what were you doing in Windsor?
Okay, I retract my question.
Guilty as charged. Hey, so question, in Wisconsin, are you big into the hockey?
No, I told you I was the fat kid that couldn't really skate. So when you were the fat kid and you couldn't skate, I was the goalie. Now, most goalies are incredibly talented athletes and a keen eye-hand coordination, like you probably. But I wasn't one of those. I just filled up a pretty big percentage of the square inches of the goal. That was my job.
As long as you play your angles and you're big, you don't have to be good, right? So
Right, exactly.
Well, I've played Jeff Roy in squash, and let me tell you, he did not have that eye-hand coordination you accused him of.
So, Jeff, let's talk a bit about MGAs in Canada. So you guys are not yet in Canada, but what do you know about the MGA market?
First of all, I'm not sure that there's anything more offensive than a new arrival telling everyone what they know about the place where they just arrived. So I think we've got some impressions that the Canadian market has at its core a group of MGAs that are important to the brokers, especially on certain of the commercial lines of business. And that's enough for us, given Accelerant strategy, which we can get into in a second. We're enthusiastic about our entrance to the Canadian market. What we do, Tom, which maybe is a little different, is we try and back management teams. So what we're going to do, we're in the process of doing it now, is meeting the various MGAs in the market, finding out what needs they have that aren't being met, what pain points they have that aren't being addressed.
Over the last 3 years, I've seen my MGA book grow by 40% on PIF just because of market conditions. And I'm talking about, commercial space, so it's bald, right? And most of the MGA business is really commercial. We're talking about commercial today, right? So by PIF, 40% growth over to the MGAs in around that space. And with anywhere from 2.5% to 5% reduction in commission, not as a percentage, I mean, from 20 down to, just because of market conditions, right? And there's a ton of good risks in there that shouldn't have gone, in my mind.
My perspective is similar to Steve. It's they've caught a really good wave in this current really tough marketplace, and I think most brokerages would have seen their MGA business swell, and we're no exception to that. Yes, the commercial certainly, but even the personal, they're major players now.
You're seeing some of the MGAs jumping into the space, looking after some of the easier stuff, like K-Insure, doing some simple quote bind and issue policies through the BrokerLift platform. You've got, Premier has tried to make it a little bit simpler to get a quote through their portal, but you haven't seen a ton of the MGAs really tackle tech. Steve, is there any ones you're using?
No, for the most part. There are those that have set up phone and quote lines and all that, but it's all differentiated processes. And what I find with the MGAs a little bit too is that, I'm bigger than some of those MGAs. They're struggling with resources as much as I am, insofar as people, like there's billing, there's MGAs I haven't got a report from in 4 or 5 months. They're trying to catch up on their billing.
Are the MGAs growing because they're doing something better than the domestic carriers, or are the MGAs growing with you because they'll take the business when the domestics won't?
Exactly. Number 2.
Is there a difference? Like their whole job to exist is to take risk, like no matter whether you're the manufacturer or wholesaler.
Right, but if you could get it placed in the regular market at full commission, you'd do it that way.
Unless it's going to burn down tomorrow, yeah.
The MGAs have during the hard market have written stuff we couldn't get placed. And then some of the MGAs are specialized in an area, like you see some MGAs really jumping into cyber right now.
It feels like they're sort of a pioneer force in that market.
We always talk about less friction, better customer experience, those kinds of customer-oriented things. Correct me if I'm wrong, but they're not winning on those metrics, right? They're winning on more defensive metrics.
Capacity is a huge issue, technology, and then some of the coverages, they will write it, but is the wording what you want to actually offer to the client, or are you scared about an E&O trying to explain all the exclusions to them? You kind of have to use some of the MGAs at your own risk too. You have to be buyer beware because you may not do as much business with them. So there's a little bit of risk added in.
The MGAs that we support, that we do business with, we call them members at Accelerant. What Accelerant does, its reason for existence, is to facilitate the success of MGAs in Canada, the United States, the UK, and the EU. So what we do is we pick a relatively small number of MGAs. We back them to the hilt. So the relationships tend to be relatively large. And what we try to do is we try to be the kind of insurance company that solves the pain points of most MGAs. And I'll be the first to admit that we're learning every day, and boy, do we have more to learn about Canada than anywhere else. So I'm going to be speaking gingerly and more referencing ground that I'm more sure of in the other territories where we're currently operating. But I guess what we saw in those territories is we saw the MGAs as being one of the few customer-centric organizations in the value chain after the retail broker. So you guys are killing yourselves trying to give a great customer experience and quick turnaround and choice and all those things that I'm sure you think about and worry about all day. In most territories, you hit the insurer, and because of lots of reasons, regulation, size, history, tech debt, technological debt, whatever the case may be, you sort of, I would imagine, you tell me, but you bang into a brick wall.
Based on whatever number of podcast episodes we've done and what I've heard these guys say in the past, yeah.
And I should have started with a lot of my comments assume that we're going to receive regulatory approval, and I would never be presumptuous to pretend or imply that we're skipping that step. So when we had to pick a distribution method, we decided to go all in on MGAs because we thought that on average they were, again, I'll use the same joke, less bad. And what we try and do with our resources and with our experience is make our member MGAs be better partners for you guys. Like, for one thing, I'd say, Steve, and I don't want to get our future customers in Canada mad at me, but I can assure you we don't pay less retail commission anywhere.
I need to clarify though, what is it you do? You do it for an MGA or you do it for a broker?
We provide insurance capacity to MGAs. The MGAs do business with you, the retail broker.
So you're a market agent for MGAs.
We're the alternative to Lloyd's.
Do you deal with Lloyd's as well?
Yes, we must have a contractual relationship somewhere, but it's not significant.
If I'm an MGA, you're my Ari from Entourage for insurance companies. You're going to market me. You're going to manage those relationships. Right?
I'm going to need help from the goalie. Jeff, do you understand anything that he's saying?
He's turtle and he's getting mouthy.
Here's what we do for our MGAs. Our MGAs, first of all, it's not like they're laying around desperate for our help, right? Generally speaking, they're really successful businesses in their markets. And what can we do? Well, we can give them limits that they need to satisfy their customers, right? If every restaurant is 3 million, it's kind of dumb to only give them $1 million in capacity, right? And then leave it to the retail broker to have to scramble and figure out what to do for the other 2. So we try and give them the limits they need. We treat them like adults and give them responsibility and authority so they don't have to run to us with referrals all the time, which slows everything down. Generally speaking, the MGAs struggle operationally and with technology. Steve, just exactly what you said you're experiencing. If members want, we're able to drop in tech solutions for the back end, which I would say probably don't create a lot of positive stuff for you guys, the broker, but it removes negative stuff. So you don't wonder where the hell the account statement is for 4 or 5 months kind of thing, right? And where we do provide or hope to provide our member MGAs with some help on the customer experience side is because we're a new company, because we're built on a modern tech stack, because we built the team differently. So we've got more software engineers than we have underwriters. We're reasonably good at helping our member MGAs get their products into a digital form that their retail brokers and their other distribution partners can access efficiently.
What's the total sum of premium, if you can talk about it, of the cumulative members?
We don't write all their business, but if you add up all the members, I'll bet you it's $1.1 billion, and that's probably euros. And we write about 700 of it.
All of those members would be able to have digital applications.
Any member can access any of the services that we provide to members. Not all of them do. Not all of them are interested.
But it's available to them, $1 billion of digital applications. All right, so third question, again, ADHD unrelated, but do you have any retail brokers as members?
Some retail brokers and wholesale brokers have decided to set up an MGA as a margin capture route, which is fine, right? That's what everyone's supposed to do. But they don't staff it or behave like it's an underwriting shop, a risk selection shop. And those we try to avoid because they tend to last about as long as a hard market or a medium market, and then they kind of fall apart. What we do support over the long term and enthusiastically are retail brokers or wholesale brokers that in order to get more margin capture, they set up an MGA and staff it with really underwriters that are told to underwrite.
So you do not offer underwriting services whatsoever. It's market access.
All of the direct underwriting is done by an MGA.
Your model then, in terms of you've set up this group and you help all these other MGAs, and do you get a percent, like 1% or 2% of the 700 million euros that go through it?
No, we're an insurance company, right? We're an insurance platform, but the important part of that platform is all the services to attract the members and make them more successful. But ultimately, we're writing all this business. So we make our money on the insurance that the members write.
So you're placing the reinsurance then, basically, in a sense? Like
we do buy reinsurance.
So when they get you in their stable of products, is it underwritten through your company and then you've got the reinsurance behind it and show your name, or do you white label the name?
It says Accelerant Insurance Company Canada. If the regulators approve that name, that's one of the things that's in front of them.
And then your SME stuff that you kind of look at, like, do you have a certain thing within there? Like, do you do everything for your members, or do you focus on like hospitality, insurtech, habitational construction?
There's nothing more annoying than an insurance company that tells someone who's been in for example, the Canadian market for 30 years, what they should do. What we do is we meet these people that have been in the Canadian market. They tell us what the opportunities are.
Nobody just overnights to $1 billion. So how did you guys get started and start adding value and figure this out?
The kernel of the team all worked together at Argo. We all left at various times in 2018. And we had participated in this MGA space for a couple of years at Argo, where we sort of came up with a strategy that was pretty close to what Accelerant is today. Argo writes at the time probably $2.5 billion of business. It's pretty global, even though it's not very big. It was pretty global. It had a Lloyd's syndicate, it had a European insurance company, U.S. insurance companies, and some other international stuff spread around. Nothing in Canada. We had this MGA idea that Chris Lee Smith, my co-founder, and I were pursuing. In 2018, we decided, look, this would be much easier. We'd be much more successful if we did this as a standalone company focused only on this with no tech debt. We could start over. We could start over fresh. So we were able to do two things that were really, really important. We were able to convince Frank O'Neill to leave Swiss Re, a perfectly good job at Swiss Re, and come across and be our chief underwriting officer. And the other thing we did is we were able to convince Altamont Capital Partners, a private equity fund in California, to be our financial sponsor. And then we were sort of off to the races. We started in December of 18. At the end of 18, I think we had 4 or 5 members, and they were writing, I'm guessing a little bit, but 150 million euros. And then 2019 was a big year. We really expanded in the UK because the reputation that we were getting, and we worked really, really hard to both deserve and preserve the reputation. We were able to grow rather nicely. So in 2019, I think we probably wrote 350, maybe just under 400 million euros. And this year, we just continued the same thing in Europe, but we launched in the US during 2021, which is obviously a very big market. So the team there has been successful, backed by a great stable of members that we're really, really proud of. And when you add all that up, they all collectively probably write just over €1 billion. We write about 700. We're sitting at 125 employees roughly now.
How can an MGA using Accelerant add operational efficiencies or improve customer experience for the retail broker like these guys?
My sort of thesis is that operational efficiencies is a fancy word for time, because everything, delays spawn everything, right? Or straight through processing is the most efficient thing that you can possibly get, right? So what kind of delays are the most expensive? The delays that involve people, where people have to circle back or cycle back, right? So I think I picked on Steve last time. So this time I'm going to pick on Jeff. So if Jeff or someone who works for Jeff, right, has to pick up that file 3 times on the phone till they understand what the quote is and can get that quote nailed down and get it confirmed, and then get the policy issued and get it fulfilled. Every time someone's got to touch the phone or do anything, that's like prohibitively expensive. And I think we don't think about it that way for whatever reason. I don't think the industry thinks about how expensive that is. So what we do is we try to give our member MGAs the mainly software tools that they need to be straight through processors.
Well, that's a great point. And that actually, in my opinion, touches both operational effectiveness and customer experience, because if your employee is doing things once instead of 3 times, and the whole start to finish cycle is shorter, that benefits obviously you have to pay you have to have less employees, and the customer gets what they needed.
Quickly, 2 questions. You've grown from nothing in 2018 to 700 million trillion euros. No, I think it was 700 million euros. Now, how do you do that? Because you have to have capital. At least in Canada, insurance company has to have capital to be able to grow. Otherwise, you go into the reinsurance market. So if you're the insurance company, are you where did the capital came from? Your investor, you said in California, and you've started to turn a profit. But do you have 80 or 90% of this reinsured, and then you have 10 or 20% you're assuming yourself? Like, how do you build that capital capacity?
Well, we've been fortunate enough to attract investors all the way along to keep up with our growth. And as you said, Jeff, it's reinsurance and capital are sort of complementary goods. I think, if I remember at school, one replaces the other. So we've grown both. We've been fortunate in being able to grow both a lot during that time period. And obviously, the big concern of everyone is, boy, you're growing quickly. Are you growing too quickly? And what we really try and stress to people is, remember, we're not growing like a normal insurance company where you have to get your price down low enough to get that risk to move, right? We're moving blocks of business from established MGAs that have been doing this for 5, 10, 15 years.
Okay, that kind of jumps into my second question was, how do you vet, like obviously in your prior life at Argo and all your experience, you've got your eye on certain MGAs that run a good shop, have 5 or 10 years of history. They just didn't start up today saying, I'm going to be an MGA and I've got no experience and I'm trying to throw a bunch of stuff on the books to build volume, but I can't underwrite, can't turn a profit. So you've picked some of the best ones to build off. Is that kind of how you vetted them? And do you have a certain list of what you're looking for?
It takes 10 seconds. Once you get 10 minutes, once you get into their office to know whether you're dealing with one or the other. So that's the first thing, underwriter led. Second thing is they have to be focused on commercial business, not exclusively, but that has to be their preponderance. The third thing is we're not very good at solving the problems of MGAs that need really big limits. So refineries or satellites or that kind of big stuff. We're just not a good partner. Track record. Now here, Jeff, you have to be a little nuanced. The whole insurance world loves to say you got to have a 5 or 10 year track record for us to support it. We try to be a little bit smarter than that, in that people have track records, not companies, right? And people move around, and we're quite happy to back people. We're also quite happy to back new ideas. when someone starts with a new idea, like many of our InsurTech members are sort of an unproven idea, we're pretty cautious, and we're very open that we're going to be cautious until it sort of proves out in the beginning. So it's a combination there, Jeff. And the other thing, which is absolutely critically important, and the only reason that when offered membership, an MGA has declined. So far, 3 have said no, thank you, and all for the same reason, which is we insist on total transparency of sharing of information.
There's no minimum volume or anything you're looking for.
I remember we were in a bar, of course. All good things happen in a bar. And I'll try and do it G-rated so you can use it in the podcast. And one of us says, gee whiz, these rules that insurance companies have sure are silly. And we said, yes, why don't we have no of those gosh darn rules? So we try not to have any rules because they're all silly. What we try to do is use our judgment and experience to evaluate each opportunity. And then, could we survive if every member was $2 million or €2 million? No, right? But they're not all that way, right? So we've got room to do some investments for people that we really believe in.
So, Jeff, can you hear me? Am I back? All right. So with that, Canadian marketplace is a little bit different, but at the same time, I want to ask, would you entertain startup MGAs that had the right formula for you, whether they had the right data, whether they had the right composition, and would you have minimum requirements?
For sure. That's where the name came from.
MGAs here, in my opinion, seem to be all the same. When I look at, I've written a risk with this MGA versus that MGA, I see the same Lloyd syndicates, the same regular insurers who have pens. They're just modifying the rate a little bit. The risk selection is just a little bit off one from another, but they're all the same contracts. I mean, I looked at one the other day with a national MGA owned by a multinational brokerage, and it had Aviva and Sovereign and the same 5 Lloyd syndicates on it.
Canada sounds like the case is pretty acute in your market, but generally speaking, there isn't a lot of choice out there for MGAs in terms of their capacity providers. They sort of have to take the small number of options that they have. And that's why we thought there was such an opportunity / need for an alternative. So our Accelerant members in Canada are going to send you a quote, and it'll be the form that they told us they wanted to sell, and it'll be the rates that they convinced us are appropriate. And at the bottom, it's going to say Accelerant Insurance Company of Canada.
Have you looked at vertically integrating, where like buying an MGA yourself, or would you ever look at buying a company in a different insurance company that was smaller to get you into a country? Would that be something you would consider as part of your strategy, or not really?
Sure. Again, subject to regulatory approval. It's public record that we're buying Omega.
So you're trying to buy Omega. So Omega is an insurance company. So by you buying that company in Canada, that'll fast track or make it easier to regulatory operate in Canada?
Yeah. So then we'll put additional capital into Omega, and Omega will start providing the capacity for our members that will discover that will agree. Will meet and agree to contract with in Canada.
So in Canada, you would theoretically have Accelerant paper as one company, but you'd also have Omega. Would you have both?
If we're successful, Omega would be renamed to Accelerant Insurance Canada or some such name.
One of the things that came up in some of our due diligence in advance of the show here is you guys track Net Promoter Score.
Yeah.
You're a few steps removed from the end customer. Why are you tracking NPS? How you doing it? Why is it important?
Well, to be clear, what we're measuring is our members. So we ask the question, there's sort of, you guys know it, there's 3 main questions, but they boil down to, would you mind recommend Accelerant to, a friend? And we're really proud of our score. It's 87. and we keep an eye on it. We keep an eye on it because it's so important. And there's probably a nice way to say this, but I'll save everyone some time. Just insurance, the industry just does not give a shit, right? It's a grudge purchase, and everyone knows it's a grudge purchase. If you had a choice, you wouldn't buy it. You don't have a choice. Give me your money. So we're scared to death of falling into that trap. So we do everything we can do to remind ourselves as a team that Accelerant doesn't matter at all. It's all about our customers. And if our customers are smart, their business doesn't matter at all. It's all about their distribution.
It's too bad the industry's largely forgot that in some areas in Canada.
Ironically, so I've worked for a few large carriers over my career, and if they did their NPS on their brokers, it's nowhere near 86. It might be 8.6, but it's nowhere near an 86.
I have to say that we're really proud of it. We work at it, and we work at it because we want to be worthy of the work that those MGAs do. And Steve, I really hope that in a year from now, or maybe 2 years from now, you'll be able to say that some of those MGAs you're doing business with in Canada, it turns out they were kind of They were kind of because they didn't have a choice, because their paper wouldn't give them a chance to be excellent.
Well, there's two things I want to cover off, and one is you talked about reaching into your customers' agency management or broker management system or whatever you want to call it to provide analytics downstream. What kind of analytics are you doing?
We're feeding back analytics from everything they capture. So some of our members capture, quote submission, quote bind all the way through, and we'll provide insights as to where they bind the most, where they don't, why, perhaps, or at least you have to go explore why. We'll explore distribution relationships, which ones are the most productive and which ones aren't, and then profitability, as well as lost opportunities to grow where the rate levels are just too big.
Can you get members between different countries at that point?
I don't think there's much insight to be gained there. We could do it. Technologically, we could do it, but comparing Norwegian motor to Spanish motor to Canadian auto generally doesn't make any sense.
Be interesting if you get the insight of how your different underwriters and MGA people, how he's closing better, the response times to quote. If you cross-lay that, like that would be universal, I would think. If you're in Norway or Spain or whatever, if you're getting back to people quick.
Oh, sorry, that we do.
Which country's kicking ass for service?
The UK, from a technology standpoint, is way ahead of any of the other territories where we operate now. And as a result, from a response time, the ones that choose to focus on that and use the software-based tools to accelerate it do so. They do really well.
Insurance moves fairly slowly. I was talking to another insurer today. We were talking about what we thought 2020 looked like back in 2010, and what does that inform us around 2030 and so on. But so you've been moving quicker than many have and changing things faster than many have. So what do you think is going to happen in the next 5 years? What do you think is going to happen to insurance in general? And what do you think you guys will look like 5 years down the road?
In the small to medium-sized commercial business, I think there's going to be a platform in the territories that we're talking about where things are organized, well-regulated, the rule of law is dependable. I think you're going to see risks trade on a platform where the vast majority of the fulfillment and the plumbing are a shared resource like a utility. And it's really a little bit of underwriting expertise applied at the beginning and a lot of capital engineering at the end. And this notion of having 6, 7, 8, or 9 insurance companies all having duplicative claims departments, duplicative everything. It's just crazy. It doesn't make any sense, right? Because none of it matters. The special sauce of every company is risk selection, pricing, right? And then capitalization. Nothing else is special. So that has to be mutualized. if we're going to stop wasting 45 cents of your customers every dollar.
I think I just heard the sound of every VP and SVP at insurance carriers of common departments just crapping their pants.
Depends how old they are.
If you're over 55, it's fine.
It'll be interesting. Like as I said, to get companies to work together in a claim experience, wow, that would be the first, or to use an outsource. They've tried using outsourced claims experience now. Some have gone, come back. There's just that whole ecosystem for claims isn't built to connect everybody. Obviously, that's coming, Jeff, where everybody's going to be connected, all the vendors. You can get stuff done, pushing it through things faster, but it's not quite built out yet. So if you can build that and, give choice of markets or choice of stuff, common claim stuff, and get rid of the friction, I'm sure you would sign us up tomorrow to use your service, right?
We'll have to set this video to autoplay on all of our phones 5 years from now and see how far, see how close Radke was to the actual truth.
What I should have used for my parting words were, I hope to have a non-digital pint with each of you after we receive regulatory approval and we can make it up, because in all honesty, we'd love the benefit of your insights.
So Jeff, Radke, thank you very much for being on the show. On behalf of the crew here, and especially our sponsors, IFS Premium Finance, the Crew Group, Garrison Brewery, and our charity partner, WIC, I wanted to thank you very much for your time and interesting thoughts, and definitely a different thought process than what we typically go after, but I appreciate all the insight you provided to us, Jeff.
Thank you. Thanks for having me. It was nice to meet you all. And like I said, I look forward to the non-digital pint in not too distant future.
Is retention important to your brokerage? Of course it is. That's why at IFS, we have a cancellation prevention process. Want more details? Give us a call. I know you don't always use a premium finance company, but when you do, you should use IFS. Cheers.
So what do you guys think? Like, Steve seems to want to start up an MGA here. I mean,
I've wanted to do that forever. They're the only motherfuckers who their response is shit. Their underwriting is ass. And they make out like, hey, every time there's a hard market, when things get tough, they make good dough. Oh yeah, 50-cent rate, whatever. Bleh.
Used to be 5 cent, Mike. Everything was 5 cent, right?
I'm struggling with going through this. I'm begging my markets to say, look, MGAs accounted for this much of my business 5 years ago. Now it's this much. But within that, and I agree, some of it, and that's why I made that comment, yeah, if it's going to burn tomorrow, that's where I put it. But there's a 50% of that stuff I have with MGAs, I would gladly put back with regular market at the right rate. The rest of it can fucking stay there because it should be there, because that's the stuff. They don't give me loss ratios. They don't give me CPC. They give me depressed commissions. You know what? If it's going to burn, that's a fucking market I'll put it with. The good stuff, I'll put with my own MGA. I'll get the overrides. I'll get 27.5% commission. I'll cream out my own MGA book in 5 minutes. And I got, and you put 5 brokers together, all of a sudden you got a $20 million MGA that's really doing stuff. Now, you may lose your regular MGA markets a little bit because they know you're selecting against them. But, I look at Taunton and, Aviva's on everything. Why? Because Hub makes them.
Bottom line is you're gonna start an MGA, work with Accelerant.
I'll do it tomorrow if Adam gives me 10 times on cheap. 10 times premium.
Well, I guess we won't be starting an MGA tomorrow anyway.
Adam, Jeff, what was your takeaways?
It's amazing to see this marketplace evolving for such a generally old capital market throughout North America, and to see more American competitors coming up here. And it's not quite InsurTech, but they're taking technology and analytics and empowering already established underwriters.
I'm going to argue it actually might be more sophisticated than an InsurTech, because the tech part is just part of their offering. It's not tech. It's not the end game. It's not, here's a flashier lead gen, here's a flashier whatever. It's here's how we do the business that we're all in better because we have this, this better underpinning.
They actually want to help us. They want to reduce friction. They want to let people want to get out of people's way, and they want to enable people, empower them to do a good job. Like hence why they have a net promoter score of 86 or 87, depending on what part of the podcast you listen to. So I thought it was super refreshing, and the fact that the market they're into is he's identified $276 billion to $300 billion. He's got $1 billion of it in 3 years. He's got funding, has been successful. It's he continues to be able to fund it and enable people. It's great. Like it seems that he's found a really cool place to play, and it's got me interested in what that would look like in Canada, right?
Well, you got to love a business model where it's set up that if my members / customers win, we win.
I remember in a previous episode, Jeff was talking about partners versus stakeholders. I mean, that's the true definition of partnership.
3 of the members didn't want to go ahead because they wouldn't share their data. They felt they had secret sauce and they were worried about that. And, by holding that back, they missed out on a lot of benefits. So
data aside, let's look at the MGAs we go to right now. Most of the MGA business I place is with competitors, right? Like Westland owns Agile, Hub owns Totten. Who else am I? But like, what are my top 3? They're all owned by my competitors, right? And they're scraping me.
They built a business proposition. They found a spot in the market and they're competing, right? So it'll be interesting. It sounds like there's a good opportunity for some disruption. It'll be interesting to see how it goes, and wish Jeff and his team the best of luck.